All right, cool. So yeah, we've been doing this now for about 7 or 8 months, and it's gone well. And we're really just making sure we get the word out to folks and share how to invest passively in real estate. It's a pretty neat thing to do. A lot of people are doing it, and I'm a big believer that the next 10, maybe the next 3 or 4 generations worth of people here could make some great returns and grow their wealth off of passive real estate investing. So just kind of the big disclaimer is, we're going to talk about a lot of things today, but obviously, if you get into this, talk to the professionals who are licensed and certified. We'll go through a lot of our experiences and what we've gone through and how we do it. But of course, there's licensed people out there that you want to get with. In our first part, we talked about putting your team together. And then there's a lot of folks on there that you could take a look at that could help you as you start embarking on this journey. And a little bit more about Doug, myself, and Dave. Dave and I are with JID Investments. Doug is with Eagles Flight Investment Group, working with that team, which is a great team. And Doug's doing some great stuff on his side with capital raising, connecting good sponsors with good investors, kind of like what we do. And we're on the same team here, so we're happy to be on with you and happy to go through this together. And if you got any questions, a little bit about our expertise there as well, if you want to check that out. And we went through this on every presentation, and really today is kind of the culmination of how this presentation's gone, this webinar's gone. We want you to be armed for success. We want you to know the difference between passive and active investing. Warren, you mentioned Airbnbs. A lot of folks are doing that. They heard that it's a fantastic investment, which it is. But there is a lot of work with that. There's a lot of operations of the property, operating the schedule, getting people in and out. So you may want to take a little less active role and join a passive investment or a syndication where, again, your hands are not as intensely focused or operating on the day to day, but you still have the opportunity to be part of ownership, be part of an investment, make good money, have a great experience, learn a ton, and rinse and repeat, which is always fun. So, want to be able to give folks the education, give them the confidence, and giving them just the sense that they can do this because people can do this. It's not terribly hard. The hardest part is really digging in when you start looking at deals and if you got the right people around you, it's a great opportunity to partner with folks that have been in business or been investing because people do this professionally. You got people who are professionally passive investors and they do it real well. They also have companies like us that do it for a living where we partner up with our investors and bring their cash in with ours to these deals. And yeah, it's a great opportunity. So that's kind of why we're doing it. So let's get started here. So here's the 7 steps. We did 1 through 6 already, and we kind of started, big pie in the sky, 50,000 foot looking down, and then really kind of focusing today on how you get back your profits, your money, how things are protected, and what you can count on in regards to determining how you get your money back and get paid. But yeah, we went through the team. Then we looked at the sponsors, the location, the types of assets that are out there, how the capital stack is put together, how you source deals from a funding standpoint, big picture, putting bank debt together, equity, and all the parts that come together to pay the bills. And then we looked at all the legal documents, your due diligence packages, your operating agreements. We'll touch a little bit on that today. But today's really, I think, the funnest of all these 7, because again, we're going to talk about how the waterfall works. And we just want to give you the information because different distribution schedules from different sponsors are laid out different ways. So that's why we want to go through today, part 7, to really kind of go through it. And at the end here, I actually want to show you a spreadsheet I put together. It's a very basic spreadsheet that would help you track cash on cash, how to track what you're supposed to get year over year, how you track getting paid, your profits at the end when you get the finish line of the project, and how return of capital and money pairs up against how you make your returns and your profits. So let's get started with part 7. So first and foremost, where do I find the distribution schedule in an investment? And so there's a couple of places you could find it. The most likely place to find it initially is in a deck or an offering memorandum. JID calls it a summary of investments, but it's the investor pitch deck. It's going to have all of the who, what, when, where, why of the deal, and give you some details. There should be a section in there that really delineates and breaks out for you how the investment's broken out and how you're going to get paid back, and how the flow of money coming back into the ownership, the partnership agreement on the equity side is paid. So that's something that you can find on the investor pitch deck. The other place you find it is pro forma. The pro forma is a really detailed breakdown and information on a project. It's usually on a spreadsheet with numerous tabs that goes from general information and given variables and things that you know about a project, to the costs, to the sourcing of the money coming in, to the rent rolls for each year, and then how monies are going to be distributed each year. So okay, in year 2 of this year 5 investment, I'm going to start getting some money out of that, and it's going to be rental income, or it's going to be from depreciation loss, or it's going to be from a refinance that is going to realize a capital gain. So these are the types of things you're going to look for. And just like I was in the military for 20 years, each dollar that's in the military has a different bucket, right? Or a different color of money, we call it. So just because you get a dollar back doesn't mean that the entire dollar goes into one bucket. The dollar could be broken up into different buckets. So you may get 50 cents on the dollar going towards rental income. You may get 20 cents on the dollar that's kind of tax savings from depreciation. You may get 30 cents on the dollar from a recapitalization event or a refinance that's going to get you back some profits. So it's really important to understand the dollar amount of you're getting back, how it plays in the big grand scheme of things, and then how is that going to impact you from either an income or a gains perspective or a tax savings perspective. The last of the three that you'll most likely see the waterfall on is either the operating agreement, which is really the legal document. We spoke about that in part 6. That's the official legal document of the project. That's going to basically delineate the roles of each of the members, how capital's contributed, if there's capital calls, ownership percentages as far as who's brought in what amount of dollars and what's that representative to the overall amount on their percentage. You'll find the operating agreement in there. You'll find the waterfall, and you'll actually see it most likely as the distribution schedule. So that's usually the section in the operating agreement that you'll see. If you're in a syndication or you're working with a group like us, JID, you'll get a private placement agreement if we're filing with the ACC, which syndications all should be doing. And in that private placement agreement, you'll have a section in there that's delineated as return to investors or distribution schedule. That's going to really lay out for you how the levels of capital are going to be redistributed back out to the investors. And you can also find that in your subscription agreement as well. The subscription agreement is usually a document that's going to have you sign for obligatory purposes to invest in a deal. So maybe on there, but most likely, definitely on the operating agreement or the private placement agreement is where you'll find it. And the most important thing is that the operating agreement and the private placement memorandum, those are legal documents. So I don't care what a sponsor or a group like us tells you in emails or what the pitch deck says or what the performance says. I want to know what it says in the operating agreement or the private placement memorandum. And if everything is lining up properly, the information that's in the operating agreement and the private placement agreement will be complementary to, and it will also be adhered to the investor pitch deck and the pro forma. Now, deals change from the time you get maybe from the deck to get the legal documents. Cost may change. The sourcing may change. Instead of getting 70% leverage from the bank, you may get 68%. So some of those numbers may tweak a bit, but you still want to ask those questions. You want to make sure that it kind of mirrors at least the percentages or the numbers in these preceding documents, the pro forma and the investor pitch deck. On JID Investments, when we put together our summaries, you can see here on the bottom left, this is what you'll see. You're going to see a chart that has what we're looking to raise total for the project, what we're investing in, what type of project it is, the minimum investment amount, and what the overall number of units that are investing under that minimum investment amount is that makes up the total collective number at the top, the initial target raise, when we usually are looking for funds. And then we have these things here we call our returns, and the returns are going to be paid out at different levels. And it depends on the deal you're in. So if you're on a value add deal, which is basically, hey, I'm in an apartment complex, I put in $100,000 and I'm going to start getting cash flow in year one of the investment. I'm going to start getting what's called cash on cash, which we'll talk about in a minute. If you're in a development deal or in a deal like with us, where it's going to be develop land, get it entitled, build the product, get the product finished, stabilize and sell it, you're not going to most likely get any cash on cash unless we get some rental income or if we get a recapitalization or a refinance event. Most of the time, you're going to get that money back on the back end of the project. But you want to make sure you see a preferred return, which is my first circle. The preferred return is basically the return that has to be paid to the investor before the group that is basically leading the investment, whether it's the sponsor or general partner, gets paid. So that's basically like your security blanket to say, hey, this deal has to make at least 10% in order for me to make the 10% or less. So if we make 10% or less on the project year over year, the investor is going to get all the returns. Okay. So not until you get that 10% a year, or if it's compounded or cumulative, which we'll talk about in a few, if you don't get at least that 10% a year, then you're going to get everything as far as the returns. The sponsor, the GP is not going to get anything. All right. The targeted overall return is the return we're shooting for. Obviously, wants to be higher than the pref, but that's the return we're trying to get you after you get your preferred return here, that 10%, and we give you an opportunity to participate in profit splits, which we'll talk about in a sec too. So the preferred return is a minimum that I need to get in order for the sponsor to collect any of their money or make any initial profits. The targeted return is what I want to shoot for to get you both your preferred return and profit splits. And then the last thing you'll probably see, you may see a couple of other things, which we'll talk about, is an equity multiple. And the equity multiple basically is the percentage of what you make back on that project. And the number one in the equity multiple is always reflective of you getting back your money. So in this instance, a 1.73x means that you're going to get back your money, which is the one, and you're going to get a 73% overall return. Okay. So I get 100% of my money back and I get a 73% return for the entire duration of the project, which is 5 years. Okay. And then on the bottom here, you'll see the timeline, how long the project is projected to be. And then you'll also see the exempt status. And the exempt status really refers to whether or not it's an accredited investor-only investment, which is a C, a 506C, or if it's open to non-accredited, qualified, and sophisticated investors, which is a 506B. Okay, the last thing I'll show, and then I'll take a pause for questions, is this is what our private placement memorandum has. So this here on the left is what's on our deck, right? This is what you're going to see in our private placement memorandum that correlates to what I have here on my pitch deck in this chart. So you can see here, it states that the company shall make the following distributions of profit, net of any expenses, or net cash flows as follows. So our waterfall, or distribution schedule, lays out the first, the second, the third, and the fourth tiers of our waterfall. And the first tier, for example, would be that the investors in the project will get 100% of the distribution on profits that equate to the 10% preferred return. So that's the first amount of money that comes out of the deal in the form of profit would go to the investors up to 10% a year. Okay. The second tier, or the second part of the waterfall for us, would mean that you're going to get back 100% of your money that you invested in. So you're going to get your 10%, you're going to get your 100% of your money back. And then at that point, we as a manager will take a percentage of profit that gets us caught up. And that's a term you'll hear a lot, catch up, which catches us up to what you as an investor was paid as a preferred return, which is your 10%. Okay. And then after we get caught up to what you've been paid out at 10%. The remaining profits are split 62.5% on this project to the investor and 37.5% to the manager. So when we get down to this fourth level, you've already been paid your pref at 10%, which is tier one. 100% of your money was returned if you brought in 40 at your minimum investment. That's $40,000. The third is I get caught up as the GP or the general partner as the management to your 10%. And then I'm going to give you the next 62.5% of the profits. And then I'm going to get the next 37.5% profit. So we're basically splitting that dollar 62.50, 62.5 cents you and 37.5 cents me. Okay, so that's an example. That's how we do our waterfall. Okay, and that's where you would see it on the private placement. I'll take a pause. Does anybody have any questions? Please jump in, or if you have any comments.
Yep, I'd like to ask a couple questions.
Sure.
I've spoke to David. I see you on there, David Schatz, but he was saying, I think you guys try to target 15 to 20, or refresh me on what y'all try to get to as an average, if you will, in these deals. And then my second question is, in reviewing something like this, when you're fairly new to the game and in the education stage, who would be best, or would it be both a CPA, an attorney? You guys have them review every one of these, because I guess you guys write this up with the help of attorneys, right? So, those are two that come to mind.
Yeah, so the 15 to 20% is what we advertise. I guess we wanted to get it to the hundredth of a percent here on this one. This project here in Charlotte was actually a little unique too, because it's actually more of a value add project, which we don't typically do, Warren. So the fact that we're able to get this 15% return on a value add, which you're usually seeing around 12, 13%, is pretty darn good for the investors. The development deals are typically what we're doing, where, like we said, we get land, we get it developed, we get it entitled, and then we're going to build on it. So this was a little bit of a unique project for us. And then your second question is, you need a CPA, obviously, to walk through the tax implications. And the real estate attorney is going to be able to help you a little bit with this. But really, it's a matter of sitting down and just kind of being able to kind of capture stage by stage how you're going to get paid back. How am I going to make my money? How am I going to collect my returns? There's a lot of great books out there that kind of go through this. There's a lot of investors that do this for a living. But as far as someone by trade that can walk you through this, it's really the sponsor and his team to be able to walk you through this, or like us as a capital raiser to walk you through this, so you understand it, if you have those types of questions. Dave or Doug, anything to add on that?
Yeah, I'm kind of skeptical. This is kind of, and for the record, Warren, I do have a law degree, so that does color my opinion a little bit here. I don't know if it's that necessary to have. This is probably bad advice. I don't know. Okay, let me just say it, and then we'll deal with the consequences. I'm not so sure how much an attorney can help you on reading the PPM. Unless they're really experienced in doing them themselves. In a way, I kind of think it's overkill, because really you don't have much pushback. You can't redline a PPM, and unless you're gonna fund the entire deal, you probably can't push back on any of the terms. I'm just kind of skeptical how much an attorney can help you too much, and then it's kind of an expensive proposition to have them teach you something you can learn elsewhere. So I guess I'm kind of skeptical on how much an attorney can help an LP on that score. I guess that's my take on that. What I would recommend in lieu probably is it's not a bad idea to have your tax expert take a look at it. I do agree with that. Also, would just say network with other LP investors is probably the very best thing you can do. Maybe even more than even than a real estate attorney, frankly, in a lot of ways. But also, it's not bad to have an attorney look at it the first time until you get comfortable and walk through it. But I just think there are other avenues that are better when it comes to that, because you can't push back really. You're not going to redline a PPM unless you're putting in all the capital for the most part.
Yeah, I'll jump in here as well. And Doug, I kind of agree with what you said. You know, unless your attorney is really a PPM expert, he's not going to be able to help you a lot. But I think as an investor, you just need to know what to look for in the PPM. PPM are dozens and dozens of pages, but there's only a few things in there that you're really interested in. You know, the return, the waterfall, like John's been talking about. You know, who's involved, who's making what percentages. So as long as you can go into that PPM and kind of filter through and get that vital information, you know, if you do that, you're doing more than 95% of the people.
Yeah, Warren, and you could always reach out to us, obviously, you know, even if it's not a JID deal, we're happy to walk through with you. Cause again, like Doug said, you know, we've been doing that. We do this for a living, but we also, you know how this works. We know people that have done these types of deals. So, and it's also good to partner with other limited partners. That's what an LP is. We'll talk about that in a sec. It's also good to know the limited partners because again, you could bounce the deals off of them just to give them their 2 cents on it and what they may see and some of the things that they could help you with. And that's just going to continue to help build your knowledge and confidence as you continue to look at more deals.
Well,
Yeah.
the guy that I'm connected with, he's an investment advisor in Texas, and he manages money, you know, for a lot of people. Very conservative guy. So we're just kind of entering into this. I delved into it first into real estate, and then it's you know, he's now in it. So here's a point. There's a group in Dallas that has Patmos Partners, and they put together decks and investment opportunities. We both went in on that. He much larger than I did, but I don't have the skills yet to just look at a deal and go, "That's a good one. That fits my profile." So having a mentor type would be ideal. But do you guys want people sharing your opportunities with people that you know? Is that I don't know if that's the right way to.
We typically don't share our stuff outside of the investors who join us as new investors, but we're always happy to sit down and share our experiences and what we've done and we can, you know, this stuff here I'm showing you is stuff that we're sharing with the public just so they can kind of understand how it works from how we see it. But yeah, every deal's different. You know, again, and that's why we wanted to do this. We want to just give you a little taste of how we do it, but also to give you the confidence. As far as a mentor, I think that's a great idea. But at the same time, I think that, like David said, if you sat down and looked at a few of these deals and you started going through them and connecting the dots, we're happy to help you with that. It'll make more sense for you. It
Yeah.
will. And
And
I
it
think
is.
when we get through the rest of this today, you'll see that, you know, the dots will be connected a little bit more for you, I think.
Okay.
Yeah. Good deal. David, anything else you want to share? We'll continue moving forward. Okay. So I wanted to explain to you where you're going to find the waterfall, the distribution schedule, and these docs. And again, making sure that the blue box is really the governing document to make sure that it kind of really shares what these two documents say. So you know, it's on the same page. So I wanted to talk about a couple of key terms. So you heard us saying these terms GP and LP. You hear that a lot. You know, the general partner is the group that is usually going to be the head of the investment. They're going to be the group that kind of does the overseeing, the day to day. They're going to be managing, and most of the time, the GP is either the sponsor or the lead group that's raising the money, like JID. And so that group is going to be overseeing the project, the investment. They're going to answer your questions. They're going to be the group that if you want to go visit the project, you talk to. If you got questions about balance sheets on the project or the financials or whatever's going on, that's the group you want to go to. The limited partner is the individuals or the groups that are part of the entity that makes up the investment side, the investor side. So the general partner is usually the managing member of an entity, and then the limited partner are the individuals or groups that are part of the investment, kind of like the silent partners, if you will. Now, the GP could also be the LP as well, or a co-LP, but most of the time the GP is going to come in and invest under their umbrella as a general partner. Okay. The next one here. accredited investor and a non-accredited investor. So, that really just is predicated by the SEC. The SEC defines what an accredited investor is by income or net worth. There are a few things that are in play that the SEC is looking at by redefining the definition for income and for net worth. They're also thinking about putting together an exam that folks can take, that if they pass the exam with a minimum score, they could be considered an accredited investor. A non-accredited investor does not meet the criteria of an accredited investor, but they can still invest in certain types of investments due to their sophistication, or they still have the capital or the income that meets a requirement that the sponsor or the capital raising group is comfortable with. Okay. Usually, you won't see somebody calling from California as a non-accredited investor to a team that's in Hilton Head and saying, "Hey, I want to invest in your project, and I'm a non-accredited investor." That preferred return and return of capital. So the preferred return we mentioned is that minimum return that the investor has to make before the general partner is going to collect any of their promote or profit. So that first level has to be met before that happens. And then the return of capital is your investment capital, the money you brought into the deal to invest. And we'll get into that a little bit more on why we break those two out here in a few. Next one is cash on cash. So cash on cash is basically what you're going to yield either on a monthly, quarterly, semi-annual, or annual basis based on what the asset is going to provide as far as net operating income or any type of profit that's going to come out. Now, the cash on cash is usually going to be less than the preferred return. And the reason why is because they're not always going to be able to hit that higher preferred return number each year. So when I get into this example, I'll show you in the next slide, you're going to get a cash on cash that's less than your preferred return. So the question is, how do you make up the difference, which is what I'm going to talk about. Return on investment or average annual return is really the straight up return you're going to make on a project. So in my last example, when I said you were making a 1.73x, the 0.73 portion, the 0.73 portion is your total return on investment or annualized return, your average annual return, which is going to be the total return divided by the amount of time you've been in the deal. So if you take the 73 or 75, divide that by 5, you're going to make an annual return of 15%. Okay, not to be confused with an IRR, which is, I think, my next one. Yep. All right. IRR. When you see an IRR, you need to make sure that the sponsor is telling you that it's an IRR and it's not really an ROI. A lot of sponsors do that. And you got to make sure you tell them, okay, so if you're telling me I'm going to make a 15% IRR, am I going to make a 15% IRR compounded, cumulative? How am I making that return? Or is it straight up? And if it's straight up, they really should be showing you as an ROI or an AAR, just not to be confused. So the IRR is usually a compounded return. That's what you want to make sure you kind of see when you see those on returns. Equity multiple we talked about, just understanding that the first number, the number one, the whole number is a return of your capital. Anything after that is your return on the investment. Now you could have a 2.25x return. So that means that you got back your money and then you made a 125% return on that investment. So that's where it gets real nice. So if you get a 5-year investment or 10-year investment, and you're making a 4x, right? That's a 300% return. So that's another way to help understand how the returns play out along with your IRR and your ROI numbers. Hurdles and splits. So a lot of times on Waterfalls, you'll get these groups that will pay you back your pref, they'll pay you back your return of capital, and then the next tier in their waterfall may be a profit split at a certain percentage where you're getting a percentage as the investor, and the managing partner, the GP, the general partner, is getting a percentage up to a hurdle. And the hurdle could be a percent that's obviously higher than the pref. So let's say the pref is 10%. And you could see a hurdle that says, hey, we're going to give you a hurdle of 15% at an 80-20 split. So what that means is I'm going to get my 10% preferred return, and then it's going to be an 80-20 split in favor of the investor until the investor has a total return of 15%. Okay. And then after that, they may have their next level of waterfall where it says, now we're going to reduce that split to 60-40 in favor of the investor until the investor hits 20%. Okay. So now we're basically reducing that profit split more in favor of the general partner and less in favor of the investor, only because the investor is getting, bigger returns there. And then ultimately you may see a final level of that waterfall that may say, after 30%, it's going to be a 20% to the investor and 80% to the sponsor. So you may actually be able to make even more than that advertised hurdle rate. And then the profit splits really are just what you're going to get paid in profits above and beyond the preferred return. Some investments offer a higher position in the capital stack or priority to get your money back with just offering you a preferred return with no profit splits. But if you're willing to take a lower priority position, or you're willing to kind of take on more risk, that's when you might see a better opportunity for profit splits. And then the last one is the promote. The promote is the profit that the general partner or the managing member makes. And again, that could be part of getting paid after the preferred returns, or it could be part of the profit splits or the catch up. And again, the catch up is, hey, I paid you your preferred return and I got you your money back. So I kind of done the first two things I needed to do. Now, as a general partner, I deserve a little bit of money from my portion for getting you there. And then the rest of the promotes or the rest of the profits are going to be split. So on an 80-20 split, let's say after that, or 70-30, the 70 or 80 that goes to the investor is part of their return. The 20 or 30 that goes to the general partner is part of their promote, their profit. A little bit blurry here. Hopefully you can see it, but this is an example again that you may see on a waterfall. Level one is a return of capital instead of the preferred being paid first. So all the money that comes out first, we go back to your return of capital. The next would be your preferred return as level two. Level three is a catch up. And then level four is your remaining distributions on a profit split, 80-20, 80% plus, however it's broken out. Okay. Here's another example of how you may see it on a deck, an investor pitch deck. This is the deal type. You're sitting as mezzanine debt, which is a little bit higher in the capital stack than just pure equity, which is nice. So you're getting a little bit more of a priority position. LTV is loan to value. So that's basically how much is being leveraged either from you or let's say the bank. So the bank's bringing in 70%. That means 30% has to come in either from mezzanine debt or equity. So that's where you see that more of a capital source thing there. Minimum investment. This is the group IWC investment minimum. So this is the group that they're going to be bringing in 25,000. So 10%, which is what we usually see. An 8% preferred return paid quarterly. So that's a preferred return, and they're going to look to pay you that out quarterly. So again, this could be cash on cash and it hits your pref at the same time, which is great. But most of the time you'll see your cash on cash, it's going to be less than the pref. Your targeted return, your hurdle, all right? This means that I'm going to get you 11%, I'm going to get you the 8%, and then we're going to get you splits to get you to 11%. And then again, continued splits to be paid out. Due diligence fees, these are just a little bit more of what you'd see. The 70-30 split is that, hey, you got 8% and you paid your pref at 8% a year, and then I'm going to pay you 70-30, 70 in your favor and 30 in mine to get you that 11% hurdle. Okay. And that's inclusive of your preferred return. And then lockup provision, nothing really to worry about there. So I wanted to give you an example of an actual deal, right? On my screen, this is a deal that I had a few years back, and it shows basically how the numbers you're going to see on a project. So here you see an annualized rate of return of 26.3 to 29.8%. So that means that's what they're going to pay you each year, right? Straight up all the way through to the end of the investment each year. That's what they're shooting for. Now, that's not going to be paid all out on the same time, but this is going to be when the project ends. And most of this is going to probably come from the profits that are earned on the project. 9% cash on cash. That's fantastic. They're saying you're going to make a 9% cash on cash each year on your on your money. And then here is your compounded return, your IRR, 19.5% to 21.3%. Now, if you go up here, here's your waterfall. And then the first tier of the waterfall is 10% true preferred return. So that means that every year in this investment, you should try to hit 10%. If you don't get paid 10%, which is most likely because your cash on cash is 9, there's going to be a gap. So what happens to that gap? Well, I'm going to show you in a second. But that 1% difference of what I would be paid from what I'm supposed to get in my cash on cash and what I'm supposed to earn from my preferred return, that's got to be caught up, or that's got to be made up either in year 2 or year 3 or at the end of the project. And that's something you need to track. Okay. Here's the annual cash on cash. So the 9% is actually an average over the 5 years of this investment. The first year, you're going to make 6.6. The second year, cash on cash, you're going to make 8.2, 9.5. So what the heck does this all mean? This means that you need to probably sit down and put together a little bit of a table or a worksheet, which I did for you. And it's going to be really helpful. Well, let me talk about the capital stack structure first. So in our previous presentation, we talked to you about how, the debt's going to always be the top priority of being paid back. So the debt's always going to get the first chunk of money when the project's over. Okay. The next group is going to be the preferred equity piece. Those are usually the guys that come in and are maybe just investing for a preferred return on their money. They're going to usually sit second behind the bank in the priority of payout. And then the third is going to be usually where we as investors are as limited partners, which is that last 10 to 15% of capital. But again, priority of payout, but lowest rate of return. Lowest priority of payout, highest rate of return. Okay. Just as a review from two sessions back. But going back to my example, here's a nice table I put together, which hopefully kind of takes a lot of this information and breaks it out to show you here on how you could kind of get see how the payout's made. So let's say, for instance, you came in on this investment in year 1, let's say it's 2024, and you brought in $100,000, okay? And cash on cash for year 1 is 6.6%. The preferred return is 10%. So I'm supposed to make 10. I made 6.6. So this group's going to owe me 3.4. Okay. So that means in year 1, I'm supposed to get 10 grand on my 100. I only got 6,600. So that means I've got negative 3,400 that I'm owed. So what I have here is if you get over the preferred return, that could go towards your investment amount. All right. If you get under that preferred return, then you need to carry that over. And this is very important because you may have a group that says, okay, we weren't able to pay you what we owed you, 10,000. We only paid you 6,600. So the 3,400 we owe you is now going to roll in to your return of capital. So your year 2 entry is now going to be, instead of $100,000, you're going to be getting paid a return on $103,400. Okay, that's a compounded return. And that's typically what JID will do, is we'll typically take the difference and add it to your investment amount. Okay, now let's go back to year 1. Let's pretend that this actually was 12%. So instead of a 6.6% cash on cash, you got a 12%. Well, I surpassed the preferred return. So that would actually mean that I basically paid you 2% more than what you actually were supposed to get. So instead of getting 10,000 in year 1, you actually got 12,000. So then you got to say to yourself, how is the sponsor going to treat my money if I make more than the preferred return? Well, the two things they could do is twofold. One, they can then reduce your investment amount and are basically now paying you back return of capital in the difference from your preferred return to what you were paid. So in this example, $2,000, which then means that your entry in 2025 is actually going to be $98,000. And now you're going to be basically getting your preferred return on $98,000. Okay. And this can go back and forth in the years. So that's why it's really nice to put this down on paper and chart it out. The other way they could do it is they could say, okay, well, I paid you additional $2,000 above your 10,000 on your preferred return. So now I'm going to go up to my waterfall and say, you know what? I'm going to pay that out as part of your next portion of your waterfall towards your profit split. And that would go towards your overall IRR. Okay. So it's really important to have the sponsor explain to them, do you carry over excess above the pref to reduce my return of capital? Or are you going to treat that as profit above and beyond and apply it to the waterfall at the next stage? Okay. With us, with JID, we're typically going to add it to your return of capital amount. So you're either going to have a reduction in basis from 100,000 to 98 in that example where I paid you over 2,000, or I'm going to add it in this example here to your 100,000. So that in year 2, you're going to have 103,400, which is now going to collect a 10% return. Okay. Does anybody have any questions on that? Does that make sense?
Is one better than the other, or do they pretty much equal out?
You know, it really just depends on the sponsor. In this example, I'm actually showing a cumulative. So with year 2, you should be getting 13.4%. I'm sorry. Yeah, 13.4% should be your cash on cash in year 2 to catch you back up from your reduction in year 1. Does that make sense? Yeah. So it just depends on the sponsor. And that's why it's important you ask. The biggest thing, though, is, again, you could look at these numbers here. At the end of the day, when you go through all the cash on cashes, at the end of the day, if you do it cumulative, they're going to still owe you 5.1%, which means that they weren't able to pay you according to the preferred return schedule at 10% each year on the cash on cash. So at the end of the deal, you're owed another 5.1% or $5,100. So how do they get that to you? Well, when the project sells and they get a profit, they owe you the first 10%, right? So they're going to owe you this $5,100 in profit before they go to the next portion of the waterfall. And they should be able to explain that to you in emails, and they should be able to explain that to you as the project moves forward. But this is a nice tool to use for tracking your preferred return versus your cash on cash. Now, once you get to the point where they say, okay, you know, we owed you 5,100, we weren't able to make you whole in each of the years to get you the 10%, we owe you 5,100. So when the profit's done, you're going to get back 5,100. You already made 44,900, right? And then you're going to get back your $50,000 of investment. If that happens, you've gotten the first level and the second level of the waterfall. You've gotten back your preferred return at 10% a year. You've gotten back your money. Okay. Now, let's say you need to get paid your profit above and beyond that. Okay. Well, the next portion of the waterfall here is 60% to a 20% IRR. Okay. So that means that you're going to get 60% of the profit of the remaining profit to get you up to a 20% IRR. So the way I did that was, if I went back into my model, I know that I'm supposed to get 10% from my preferred return each year, but now they're going to give me another 10% to get me to 20 in each year as well. So 10, I need to get $10,000 in year 1. Again, I carry it over because, you know, in year 2, I'm going to make $11,000 because they owe me money. So you go all the way through this. And so in order for us to get a 20% IRR with a preferred return on our 100%, a 100,000 investment, I need to make about $61,000 of total profit. And that's inclusive of my $50,000 preferred return plus another $10,951 I'm sorry, let me say that over again. I apologize. That's actually in addition to your 50,000. So you can see here, you got your preferred return at 50 plus another 10% in profit over the 5 years. So you're actually making $61,000 of profit when the project sells. So you're actually making almost $111,000 of profit on your $100,000 investment. So you're making a 22.2% return annualized and you're making a 2.1x, you're actually making 110% return on that project if they can get you to that 20% IRR hurdle. Okay. So that's another thing to write down or try to track year over year. And then the next level would be 40% at 30% IRR. So now they're going to try to get you another 10%. So what I did down here was, instead of doing it on this number, I did it on 30%. And so I know they're going to give me 10,000 in year one. I'm supposed to make 20,000 total in profits to get me to a 30% hurdle. So in year one, I should be getting $30,000 at that point with the profit split and the preferred return. And I carry that out. I did the compounded return here. So if you were able to get to a 30% return, which you probably won't, you're going to be making close to $149,000 of profit on your $100,000 investment. The $50,000 preferred return and the $150,000 here. So you're going to be making close to $200,000 of profit. That's a 3x return. The way that this is drawn up, you're probably not going to hit that 3x. You're probably going to be around 2.1, maybe 2.3 from the way the IRRs are played out from the profit split. So this is all projected, right? So what I would say is put this model together from what you get in your waterfall, okay, and what you get in your documents. When you actually start getting the money out, you should have one just like this, but it's actual, okay? And then measure the actual versus the projected. That way it gives you an idea of how you performed versus how you projected to perform. And then the only other thing that this doesn't really kind of dig into is your depreciation, which is kind of some tax benefits. And then remember this, cash on cash, or if you get any portion of your preferred return, is treated as income. So that's considered either income or interest. So you need to make sure you get with your accountant so that way they can make sure that you have a good tax strategy as you start making this cash on cash, because all these monies are going to add to your income. This profit down here, these numbers down here are going to be captured in year 5 when you exit, right? So that's going to be considered long-term capital gain. So Warren, if I was going to use your Airbnb as an example, you're making income on your Airbnb for each of your tenants that are coming in year over year, right? Each time you come in, each time somebody comes in and pays you rent and you make net operating income, you've got to, put that down as income on your tax return, right? But when you sell that property, like you say you're thinking about doing, and you make a profit on the sale of the property, that's most likely going to be long-term capital gains, okay? So again, not an expert there, but just from my experience, that's probably what you're going to experience. You make money on the property from the tenants renting the space, that's income. When you sell the property and you realize a gain in over a year's period of time, that's a long-term capital gain. All right, I know that's a lot of information. I hope that makes a little bit of sense. But the takeaway here is make sure that you at least can track this and that you can measure it to see how they projected you would do versus actually how you did. And when they try to get you back money, you can ask these questions like, hey, how did we perform? Were we able to make the 60% at the 20% hurdle? Were you able to do better than that? And if they say, yeah, we actually were able to make that 30% and you should have got that, but you only get this amount, that's when you can go back and start asking some of those questions. That's all we got. So I know a lot of good information. Hopefully, I went through that, quickly, but hopefully in a way that it made sense. And so I will now pause to take questions, or if anybody's got comments or anything, please jump on.
That was very informative. Do most of your projects track pretty closely to your projections, or have you seen them? What's the worst one you've seen? I mean, or do they typically do better? I'm just curious.
Yeah, Warren, it obviously COVID had a big impact on some of our projects. Obviously we're seeing some challenges in the economy, but that's why, like on our up to our parameters here. That's why with our company, we want you guys to sleep well at night. So that's why we have a preferred return where the investor knows their money and their preferred return is protected, and that, it's not guaranteed, but you at least know that if we don't perform as well as we do, we still want to make sure that we do our best to get you that preferred return, the return of your money. If we could do that, that's important. But we've hit our numbers on all of our projects that have completed. Few of them were a little bit under estimations. I think we made maybe 13 or 14% a year, but we try to stick to that 15 to 20%. We probably will see a few that we've had a little longer, only because the duration has gone out longer. Not that we made less money, it's just that the time aspect of it has kind of diluted the return a bit. But so far, knock on wood, we've had success on all of our projects.
Yeah, David said something to that effect, that you've never, lost on one, or something to that effect. And how do you find your projects? I mean, is it just your relationships you guys have formed over the years?
Yeah, we typically go out and try to find the sponsor first before we find the deal. And we've got very, very very critical parameters of the sponsors we work with to make sure that they're a good fit, because we want to be able to make sure that you as an investor feel the same way about sponsors like we do. So we want to make sure that we've met with them, we broke bread with them, we went to their projects, we've gone through their deals. They're the type of company we want to work with. They see that we can bring value to their business, and they're a team player. So that's important. Before we even look at a deal, that's kind of the first thing we do. And then we'll start looking at their deals. Obviously, we got to make money. So that's also a big part of that preliminary discussions. Guys, David or Dave, or even Doug, if you want to jump in on some of the things you guys look at for deals or sponsors.
Well, I concur, John, with what you said. We really are driven by the sponsor more than anything. It was almost shocking to me. The more I got into this aspect of it, it really became more and more about the sponsor, and almost not to say the deal doesn't matter, but if the sponsor's not right, everything else doesn't matter.
Yeah, and I'll let Dave, if he wants to jump in, or David, but that's why we covered the sponsor in part two, Warren, because to us, the sponsors really, they're the ones that are going to make or break the deal. They're going to be the ones that get through the good times and the bad times. They're the ones that have the relationships and the experience with banks. And we're seeing that right now in a lot of our deals, is that the sponsors we're with are not, they're still feeling it, but maybe not as terrible as a lot of other sponsors are, who have had to forfeit the keys and give them back to the bank, which is horrible. So that's how we kind of did it in this sequence when we did the presentation.
And one of the things that's really important to us as a company, and you may or may not see this with other companies, is, we believe in building relationships all the time. We don't just recruit, investors or try to meet new investors when we have deals. We try to meet people and bring them on, as investors with us when we may or not have an active deal, or we're not trying to capital raise. And the reason that we do that is we want to be able to really take our time and kind of show you previous deals, show you previous PPM packages and summaries, so you can kind of get a good feeling for how we do business in the past and how we intend to do business in the future.
Yes, sir.
Great educational thing y'all are doing. I'm going to be working my way through all of them. So.
Well, good. We got them all recorded. You can find them on the website.
Did you see that, Warren? They're also, the YouTube playlist is down in the chat as well.
Yep. I think I've watched one and started another one. So,
good. And yep. Obviously you're part of our investor family. So reach out anytime if you got any questions on what we're doing, and anything we could help you with as well. Consider us to be there to help you out as a resource.
Thank you, gentlemen.
Yeah. Thanks for coming out. We appreciate it. Spread it around if you could think of anybody that could utilize it, and pay it forward.
Sounds good.
Great. Doug, Dave, David, Jack, if you're still on, thanks, guys. This was great. I know this was
Thank you so much, John. This one crushed. Thank you so much.
Yeah, please share it with the world. And yeah, would have been good to get some more, but that's okay. Hopefully people will like it and ask for an encore.
David Schatz, let's play golf again. I'll try to bring a game with me this time.
I'm ready. It's getting a little warmer, so let's get out there and hit that little thing. Because last time I went out, I hit it way too many times.
Oh man, you smoked me so bad, I almost just gave it up.
Yeah, make sure he gives you a couple of strokes. He does that for me.
Oh,
And Warren, I hope to get a chance to meet you when I come down to visit. So definitely be
Yeah.
great to catch up with you.
Lo-
Yeah,
love to.
sounds
All right,
great.
see you guys.
Take care, guys. Thanks,
Take care.
Doug.
Have a good one, guys.
Yeah, let us know when it's available. We'll send it out there to the LinkedIn world.
Absolutely, will do.
Okay, see ya.
All right, bye.
Bye.